Mark is 44, makes $95,000 a year, has been investing for 11 years. He does everything his advisor told him. Diversified portfolio, low-cost index funds, rebalances every year, doesn't panic sell, contributes every month without fail. 11 years. $187,000 invested. His portfolio is worth $214,000. He made $27,000 on $187,000 over 11 years. That's 14% total. Not per year, total. The S&P 500 returned 247% in that same period. Mark didn't underperform because he was stupid. Mark underperformed because he followed advice that sounded smart, felt responsible, and was repeated so many times by so many credible-sounding people that he never once questioned it. My name is Bobby, and I spend way too much time thinking about how Wall Street built an entire industry around advice that keeps your money moving through their products, through their fees, through their systems, while yours barely moves at all. If you've ever followed the rules and still felt like you were falling behind, subscribe and hit that thumbs up, because this one is going to hurt a little. Here's the thing. The investment advice most Americans follow wasn't designed to make you wealthy. It was designed to make you compliant. Compliant investors don't ask hard questions. They don't move their money. They don't challenge their advisor. They sit in their diversified, rebalanced, fee-generating portfolio for 30 years and feel responsible while the people managing that portfolio get rich off the fees it produces. The advice sounds like wisdom. It gets repeated by people with credentials and nice offices and charts that go up and to the right. It gets validated by magazines, podcasts, television segments, and your brother-in-law who took one finance class in college. And almost none of it holds up when you actually look at the data. There are 5 pieces of investment advice that 90% of Americans believe without question. 5 things that feel like common sense, sound like prudent financial planning, and are repeated endlessly by the financial establishment. And every single one of them has either been debunked by academic research, exploited by the industry to extract fees, or quietly abandoned by the very institutions that promoted it. Let's go through them one by one. Let me take you back to 2008 for a second, because understanding what happened then is crucial to understanding why the first piece of advice is a lie. The financial crisis hits. Markets collapse. The average, diversified retail portfolio, stocks, bonds, international funds, REITs, the whole spread drops 37% in 12 months. People who did everything right, who diversified exactly like they were told, who held every asset class the textbooks recommended, watched more than a third of their wealth evaporate. Meanwhile, the institutions that sold them those diversified portfolios collected their 1% management fee on the way down. Here's what the industry never tells you about diversification. It protects you against one specific type of risk, individual company risk. If you own one stock and that company goes bankrupt, you lose everything. Diversification eliminates that scenario. That's real. That's valid. But diversification does almost nothing against systemic risk. When the entire market falls 2000, 2008, 2020, 2022, diversification doesn't save you. Everything falls together. Your domestic stocks fall. Your international stocks fall. Your REITs fall. In a true market crisis, correlations between asset classes move toward one. Everything goes down at the same time. A 2014 study published in the Financial Analyst Journal found that during the 10 worst market months between 1990 and 2012, the average correlation between global equity markets jumped from 0.45 inches normal conditions to 0.76 during crashes. The assets that were supposed to move independently started moving together precisely when diversification was supposed to matter most. Diversification is a tool for normal times. In abnormal times, the times that actually destroy wealth, it fails. And the industry knows this. But they keep selling it because a diversified portfolio with 12 funds generating 0.5% expense ratios each is far more profitable to manage than a simple 2-fund portfolio. The stupidity isn't in diversifying. The stupidity is in believing diversification is a shield when it's actually just a spread. This one is so deeply embedded in American financial culture that saying it out loud feels like attacking the flag. Your home is not an investment. Let me say that again. Your primary residence is not an investment. It is a consumption asset that you happen to live in. Here's the math that nobody runs. Robert Shiller, Nobel Prize-winning economist, Yale professor, the man who literally built the index that tracks U.S. home prices, analyzed inflation-adjusted home price returns from 1890 to 2012, over 122 years of data. His conclusion? U.S. home prices appreciated at an average of approximately 0.6% per year above inflation in real terms, 0.6% annually in real terms. The stock market, over the same long-run period, has returned approximately 8% annually above inflation in real terms. That's more than 11 times the real return of residential real estate. But that's before you account for what homeownership actually costs. Property taxes. Maintenance historically around 1% to 2% of home value annually. Insurance. Transaction costs when you buy and sell, typically 6% to 10% of the home's value in realtor commissions and costs alone. Interest on your mortgage, which over a 30-year loan can cost more than the original purchase price. When you factor in the true all-in cost of home ownership, the average American home generates a negative real return over most holding periods. The reason this myth persists is psychological. When your home goes from $300,000 to $450,000, you see $150,000 in gains. You don't see the $180,000 in mortgage interest you paid. You don't see the $60,000 in maintenance and repairs. You don't see the $40,000 in property taxes. You don't see the $27,000 in transaction cost when you sell. Strip all of that away, and the average American homeowner made almost nothing in real terms while congratulating themselves on their best investment. Wall Street loves this myth because it keeps your capital tied up in an illiquid asset that generates fees for mortgage, lenders, insurance companies, and real estate agents instead of compounding in market assets that might actually build generational wealth. Wait, before you close this video, hear me out. I'm not saying don't contribute to your 401k. I'm saying the blanket advice to always maximize your 401k contributions up to the $23,000 annual limit is one of the most financially destructive pieces of advice handed to American workers. And the mutual fund industry is the primary beneficiary. Here's why. The average 401k plan in America contains 19 investment options. Of those, the vast majority are actively managed mutual funds with expense ratios averaging 0.88% annually. That sounds small. It isn't. A 2023 analysis by the Center for American Progress found that a worker who starts contributing at 25 and retires at 65, contributing $6,000 per year into a typical 401k with 0.88% average fees, will lose approximately $138,000 to fees over their career, compared to the same contributions in a zero-fee index fund. $138,000 gone, not to market losses, to fees, for the privilege of holding the exact same underlying assets in a slightly more expensive wrapper. But here's the deeper problem. Maximizing your 401k to the exclusion of everything else creates a retirement savings monoculture. All of your wealth is locked in a tax-advantaged account you cannot touch without penalty until you're 59 and a half. It's completely illiquid. It's concentrated in whatever limited options your employer's plan provider chose, and it is entirely dependent on market performance at the specific moment you need to withdraw. The smartest investors don't blindly maximize their 401k. They contribute enough to capture the full employer match. That's free money. Take it every time. Then they evaluate whether a Roth IRA, HSA, or taxable brokerage account with low-cost index funds gives them better flexibility, lower fees, and more strategic tax positioning for their specific situation. The 401k is a tool. Like any tool, it's only useful when applied correctly. Maximizing it blindly, in a high-fee plan, to the exclusion of all other vehicles, is exactly what your plan provider wants you to do. Follow the incentives. You've heard this 1,000 times. When the market drops, it's a buying opportunity. Buy the dip. Be greedy when others are fearful. Warren Buffett said it. CNBC says it every correction. Your investing group chat lights up with it every time the S&P falls 5%. Here's the problem. Buy the dip assumes you know when the dip is the dip and not the beginning of a cliff. In March 2000, the Nasdaq dropped 10%. Dip buyers loaded up. It kept falling and falling and falling. By October 2002, the Nasdaq had lost 78% of its value from peak to trough. Every dip buyer on the way down lost more money than the one before them. In September 2008, the S&P 500 dropped 9% in a week. Dip buyers called it an overreaction. It dropped another 45% before bottoming. The academic literature on dip buying is brutally clear. A 2020 study in the Journal of Portfolio Management analyzed retail investor behavior during corrections and found that dip buyers, investors who increased equity purchases during 10% plus drawdowns, underperformed passive buy and hold investors by an average of 2.3% annually over the following 3 years. They underperformed by trying to be smart. Why? Because dip buying requires you to be right twice. Once when you decide it's a dip worth buying, and once when you decide to sell. And retail investors, driven by recency bias and loss aversion, systematically get both decisions wrong. They buy dips that become crises and sell recoveries that become bull markets. The honest version of this advice is, if you are going to invest the money anyway, a down market is a fine time to do it. But buying dips as a deliberate strategy, on top of your regular investing, with money you weren't planning to invest, that's speculation, dressed up as wisdom. And Wall Street loves it because active dip buyers generate trading commissions, emotional decisions, and taxable events, all of which benefit the house. Let me be precise here because this one gets misrepresented constantly. There are situations where a financial advisor adds genuine value. Complex estate planning, business sale proceeds, navigating a significant inheritance, coordinating tax strategy across multiple accounts and income streams. If your financial life is genuinely complicated, a fee-only fiduciary advisor, one who charges a flat rate and is legally required to act in your interests, can be worth every dollar. That is not what most Americans have. What most Americans have is a commission-based broker or a fee as percentage of assets advisor whose compensation structure creates a direct conflict of interest with their client's best outcome. Here's the math on a percentage of assets advisor. You have $400,000 invested. Your advisor charges 1% annually. That's $4,000 per year. Over 20 years, assuming 7% market growth, that 1% fee compounds into approximately $214,000 in lost wealth. Not fees paid, wealth destroyed. Because that $4,000 per year wasn't just taken from you. It was taken from you before it could compound for 2 decades. A 2015 study by the Obama administration's Council of Economic Advisors found that conflicted investment advice influenced by advisor compensation structures, cost American retirement savers approximately $17 billion per year in excess fees and suboptimal investment returns. $17 billion every year, quietly extracted from retirement accounts by advisors whose legal obligation, in most cases, is only to recommend products that are suitable, not products that are optimal for you. The alternative is straightforward. For most investors with straightforward financial lives accumulating wealth through market returns over time, a 2-fund or 3-fund portfolio of low-cost index funds at Vanguard, Fidelity, or Schwab requires no advisor, generates near-zero fees, and historically outperforms the majority of actively managed advisor-directed portfolios over any one 5-year period. The best financial advisor for most Americans is a Bogleheads Forum, a fee-only CFP for periodic check-ins, and the discipline to leave their index funds alone. Bobby, these strategies have worked for millions of people. Are you really saying everyone is wrong? I'm saying everyone is operating on incomplete information. Buy and hold index investing does work. Homeownership does build some wealth for some people in some markets. 401ks do provide real tax advantages. None of these strategies are entirely wrong. The problem is the blanket, unqualified, one-size-fits-all way they get applied, without acknowledging the fees, the real costs, the limitations, and who benefits from your compliance. What about people who can't pick their own investments? Isn't a managed fund better than nothing? A target date index fund from Vanguard or Fidelity with a 0.1% expense ratio requires zero investing knowledge and zero active management. It automatically rebalances. It adjusts risk as you age. It outperforms the majority of actively managed funds over 5-year periods. The idea that you need expensive management to invest successfully is itself one of the industry's most profitable myths. Isn't some of this advice just being overly pessimistic about a system that has created enormous wealth? The U.S. equity market has created enormous wealth. The financial services industry has captured a disproportionate share of it through fees, commissions, and conflicted advice. Those are both true simultaneously. You can believe in the long-run power of market investing and still reject the layer of extraction that sits between you and those returns. In fact, the most important investing decision most Americans will ever make isn't which stocks to buy. It's how much of their return they allow the industry to take.